In this introduction to accounting for companies, we shall briefly examine the types of companies that are in existence. Thereafter, we shall walk through the important concepts and terms associated with the main source of funding, that is, share capital. Debenture is another chapter altogether, which we shall study subsequently. Now, the company is an entity. It is a person, not born of a woman, and hence does not suffer death as a normal person would die. Instead, it is an artificial person, born through a process of law. It comes into existence when it is incorporated under the law. For this reason, it will continue to enjoy a perpetual existence until it is wound up, again through a process of law. This artificial person or entity is distinct and separate from the members who are the shareholders. Therefore, it would continue in existence irrespective of its members and will continue or survive in existence even after the death of its original members. For the same reason, the ownership of the entity or company may change hands. That is, the company has provision for the transferability of shares and thereby its ownership. The constitution of a company allows for the separation of the management and the owners. In a large company, the ordinary day-to-day affairs of the company obviously cannot be run by the many shareholders who are the owners of the company. Instead, they elect competent members to the board of directors to represent them in the management of the day-to-day affairs of the company. In the next segment of the introduction, we shall discuss in detail about the main sources of funding and the accounting for the same. We shall now describe briefly the types of companies. Companies may be classified based on the liability of the members. Companies are also described on the basis of the ownership pattern, which we shall soon see. Meanwhile, companies where the liability of the members is unlimited are rather uncommon. A few thousands of them are registered in India. This form of company incorporation places an unlimited burden on the owners to cover the company's debts, specifically when the company faces liquidation. One of the benefits, however, of forming a private unlimited liability company is that the disclosure requirements are few, thus effectively shielding and protecting its financial affairs from the public, media, and competition. Shareholder dividend payments are also not disclosed. However, generally, the liability of the members is limited in most companies. In some cases, it is limited by guarantee. That is, the members agree to pay a minimal amount when a company is about to be wound up. Any establishment limited by guarantee still has a legal identity separate from its members. But mostly, we come across companies where the liability of the members of the company are limited to the extent of the unpaid amount on the shares owned by the members. The company can call upon the liability and demand from its members the unpaid amount on its shares while the company is in existence or on its winding up. The articles of association in these cases provide for the transferability of shares. The common seal of the company is the signature of this artificial entity or company. The common seal affixed to a document lends authority, and the company would be bound to the commitments laid out in the documents to which the common seal is affixed. Nowadays, however, the signature of two directors is the equivalent of the common seal and is seen substituted in place of the common seal. Also, the signature of the company secretary along with the signature of a single director is sufficient to bind the company instead of a common seal affixed to a document. Transferability of shares is restricted in a private company by its articles of association. The maximum number of members is limited to 200. Past and present employees are not counted in the 200. That is, there can be more than 200 members if the shares are continued to be held after their procurement while in employment. Besides, they are prohibited from inviting shares from the public. The minimum number of members is obviously 2. Otherwise, it would be a one-person company.
A private company could also be a small company. A small company as defined under the Companies Act.
Small companies do not have any separate procedure to obtain registration under the Act. It is registered as a private limited company. But the Act differentiates a private company as a small company based on its minimal amount of investment and lower turnover. The aim is to provide directed advantages and encourage this special segment which plays a significant role in a country like India in providing employment and boosting profits. The name of a private company ends with the words Private Limited. This will indicate to the outside public, such as creditors, suppliers, etc., the limited nature of the liability of its members. This also has the effect of differentiating it from a public limited company, whose ownership is larger and generally more dispersed. Public companies are also subject to more scrutiny and therefore perceived to be more independent of the owners and hence more safe. Public limited company is not a one-person company, not a private limited company.
It could be a private limited company if that private limited company happens to be a subsidiary of a public limited company.
It should have 7 members. The name should end with the words limited.
The name of a private company, on the other hand, ends with the words private limited.
A company whose shares are traded on a stock exchange is known as a listed company. It must comply with the listing prerequisites of that exchange, including minimum earning levels or how many shares are listed. A company may also be characterized in terms of its ownership, that is, the shareholding pattern of the company. Thus, a government company is one in which the central or state government holds 51% or more of the paid up capital. Now, why would a government want to set up a company in the first place? Well, it's comparatively easy to establish by incorporating it under the Companies Act. Otherwise, government would have to pass a bill in the parliament. Moreover, it promotes competition with private sector on business lines without the baggage associated with the public sector, making it more competitive and efficient. The relationship between holding company and its subsidiary is interesting. Essentially, if one company holds more than 50% of the shares of another company or appoints a majority of the other company's directors, the second company is a subsidiary of the first. The first company is called the holding company. If the holding company owns 100% of the shares of the subsidiary is known as a wholly owned subsidiary. Now, what is the need for this structure of ownership? For one, it creates distinct entities with separate management. For example, FMCG products can be housed under one subsidiary, and consumer durables and electronics can be in another. This enables the value of different businesses to be captured separately. It facilitates buying and selling of an individual business. An investor can directly acquire shares of the company it is interested in.